All right, let's dig into AMD's latest earnings report. On the surface, the company is on fire, an absolute success story. But if you look a little closer, there's a puzzle, something that has Wall Street completely split. So we're going to break down what's really going on behind the numbers.
And this is the central mystery, right? AMD comes out, posts some of the best numbers in its history, just crushing all the expectations. So why on earth did the market turn around and send the stock price tumbling? It just doesn't add up. Let's find out why.
First off, you got to appreciate just how fantastic these headline numbers were. I mean, a record-breaking $9.25 billion in a single quarter. That is a massive 36% leap from the same time last year. This wasn't just a tiny beat, it was a huge signal that whatever AMD is doing, it's working.
And yet, despite that incredible news, this is what happened. A pretty big drop in the stock price right after the announcement. It's a total contradiction. You have to ask yourself, what did the big investors see that maybe the rest of us missed?
So that brings us right to our first section. We're calling this a confusing victory, and we're going to unpack the paradox behind these Q3 results. It's time to peel back the layers and find the real story.
Well, it turns out Wall Street wasn't even really looking at the huge revenue number. Nope. Their eyes were fixed on a totally different part of the report, the balance sheet. One single, seemingly boring metric was apparently enough to spoil all the good news.
And that single metric leads us right to the heart of the whole issue, what we're calling the inventory paradox. This is where we get to the bottom of the market's biggest fear.
This is it. This is the number that sent everyone into a panic. 158 days. That's AMD's inventory days. So what does that actually mean, and why was it so scary for investors? Okay, so inventory days, or DIO, is pretty simple. It's just the average number of days a product sits in a warehouse before someone buys it. Now, in the fast-moving world of tech, a high number like 158 days is usually a giant red flag. It screams that demand is weak and you're stuck with warehouses full of chips nobody wants.
But here's the twist. What if Wall Street got it completely wrong? What if that traditional thinking doesn't apply here? This analysis argues that this isn't a sign of weakness at all, but actually a calculated, even brilliant move. This isn't just unsold product. It's a strategic stockpile.
So here's the breakdown of that strategy into three key parts. First, AMD is hoarding critical, hard-to-get components, things like high-bandwidth memory and advanced packaging that you absolutely need for their next-gen AI chips. Second, they're stocking up the supply chain for their new consumer CPUs and GPUs, getting ready for a big launch. And third, they're fulfilling massive orders for partners like Sony and Microsoft, which probably means a new generation of game consoles is on the way. You see, this isn't weakness, it's them getting ready for a major offensive.
And this quote from the analysis just nails it. AMD is willing to let one metric on their balance sheet look a little messy in the short term because they're playing for a much, much bigger prize, a dominant share of the AI market in 2026.
Okay, so how does a big pile of inventory connect to their grand AI ambitions? Well, this is where we start to see AMD's master plan to go head-to-head with NVIDIA.
A lot of those stockpiled parts are for this monster of a chip, the Instinct MI350. And just look at that key spec, memory capacity. At 288 gigabytes, it completely blows away NVIDIA's top chip. So why does that matter? It means a single AMD card can run these huge AI models that would normally require a whole bunch of NVIDIA cards chained together. For customers, that's a game changer. It means lower costs and way less complexity.
And hey, this isn't just a theory, it is already landing them some gigantic deals. We're talking OpenAI, the company behind ChatGPT, building a massive system with AMD GPUs. And Oracle Cloud has already committed to deploying tens of thousands of their next-gen cards. I mean, these are massive votes of confidence from the biggest names in the AI game.
So after all that, what does this actually mean for investors? Let's get to the investment verdict and see how this different way of looking at things changes the entire picture for AMD's valuation.
When you put AMD side by side with its rivals, something really interesting pops out. Its forward price-to-earnings ratio, which is basically a measure of how expensive a stock is way lower than NVIDIA's. But the number you really want to look at here is that PEG ratio.
So the PEG ratio is great because it compares a stock's price to its expected growth. And the rule of thumb is that any number below 1.0, like AMD's 0.8, is often a sign that a stock might be undervalued. It suggests the market just isn't giving the company enough credit for how fast it's expected to grow.
Now, of course, this isn't a sure thing.
let's be real about the risks. You've got geopolitical tensions that could mess with chip exports, AMD is super reliant on its one manufacturing partner, TSMC, and let's not forget, NVIDIA's CUDA software is a huge, powerful advantage that's really tough to compete against.
Which all leads us back to this final big question. The market saw a scary number on a balance sheet and punished the stock. But what if it was looking at the wrong thing? Is Wall Street's short-term fear creating what might be the biggest missed investment opportunity for the future of AI in 2026? Now that is the billion-dollar question.